How to choose lot size in Forex? Selecting the appropriate lot size in Forex trading is a critical aspect of successful risk management. It directly influences the potential profits and losses associated with each trade. By understanding the various lot sizes available and the factors that should guide your decision, you can make informed choices that align with your trading goals and risk tolerance. A standard lot in Forex trading represents 100,000 units of the base currency. For instance, if you trade a standard lot of EUR USD, you're buying or selling 100,000 euros. To cater to traders with smaller account balances, smaller lot sizes are also available. The mini lot, 10,000 units, the micro lot, 1,000 units, and the nano lot, 100 units. When determining the ideal lot size for your trading, several key factors should be taken into consideration. First, your account size plays a crucial role. It's essential to avoid risking a significant portion of your capital on a single trade. For example, if you have a $10,000 account, risking 2% per trade would limit your maximum loss to $200. Your risk tolerance is another important factor. If you're comfortable with higher levels of risk, you may opt for larger lot sizes. However, it's important to remember that higher risk also comes with the potential for greater losses. The characteristics of your trading strategy also influence the choice of lot size. For instance, high-frequency traders may prefer smaller lot sizes to minimize risk, while long-term investors might opt for larger lot sizes to capitalize on potential price movements. Setting appropriate stop-loss orders is essential for risk management. Ensure that your stop-loss levels are realistic and align with your risk tolerance. This helps protect your capital in case the trade moves against you. Leverage can amplify both profits and losses. While it can enhance returns, it also increases the risk of substantial losses. Use leverage cautiously and be aware of the associated risks. Market volatility can also impact your lot size decision. During periods of high volatility, it's generally advisable to reduce your lot size to mitigate potential losses. A common method for calculating lot size is using the risk-reward ratio. This involves determining the maximum percentage of your account you're willing to risk on a single trade and calculating the corresponding lot size based on your stop-loss and profit target. To ensure successful Forex trading, it's advisable to start with smaller lot sizes, especially when you're new to the market. As your confidence and experience grow, you can gradually increase your lot size. Regularly review and adjust your lot size based on market conditions and your trading performance. By carefully considering these factors and using appropriate risk management techniques, you can choose the optimal lot size for your Forex trading and increase your chances of long-term success.